All right, folks, welcome to Investing for Beginners podcast. Today, we're going to talk about back to the basics. So, if you are new to the show, we are going to talk about why you should pick stocks, why we think this is the best way to grow your wealth. And I'm going to throw it to you, Andrew, to get us started, and let's see where this takes us.
The reason why you want to pick stocks or buy stocks, be invested in the stock market in order to grow your wealth is because over history, that has been the best way to passively grow your wealth. And we're not talking about history like, since the inception of TikTok or since the pandemic, you know, we're talking about hundreds of years that the stock market's been around, over 100 years for the US stock market. It is a pretty reliable thing. And when you start to hear the basics about how it works, why it works, to me, I got a light bulb moment. I hope you can get a light bulb moment that it's like, okay, history tells us this, the data tells us this, and it actually makes a lot of sense and it's not super complicated. And so that's why we want to invest in the stock market.
Mm-hmm. Yep, exactly. And if you look over the history of just taking the United States, if you look over the history of the kinds of returns that you can get, if you the stock market is the highest, it's around, depending on which chart you look at, 9 to 10ish%, somewhere in that range. Then you look at bonds. Bonds is going to be in the 5 to 6% range. And then you look at something like savings accounts. Those, have fluctuated, but those are 2 or 3%. And you look at maybe treasury bills, 2 or 3%. So over 100 plus years, the best way for you to make money to grow your wealth, the money that you work hard for, set aside, and you want to use someday, is to put it in the stock market. Now, it doesn't mean that you have to buy Nvidia or Microsoft or Netflix or whatever the shiny object is. You can buy S&P 500. You can buy the whole stock market, VOO. You can buy the whole global market. So you can buy everything. You can do it just very simply by just buying those kinds of investments, or you can do what Andrew and I do, which is buy individual companies because we like that challenge and we like that process of learning about the businesses. And they can also, sideline is they can also help you grow your wealth. And so if you compare those two things, that's the best way to grow. And it doesn't have to be as risky as everybody thinks it is. Everybody thinks when they start off, oh my God, it's a casino and there's just no way that I can do this. And absolutely, there is a way you can do it for sure.
So break that down then. Like, what does it even mean to have a stock?
Well, it's not. It's most people associate it with a ticker on their phone or a electronic symbol on CNBC or something that's scrolling by underneath. It's not that. It's what it is you're buying a piece of the business. So when you invest in Berkshire Hathaway, which is a company that Warren Buffett owns, you're buying a piece. You're becoming a part owner with Warren. And that's what you're doing is you're buying a small piece of that business. Depending on your financial resources, maybe it's a bigger slice than others, but you're still buying a small slice of a business. So you're becoming a business owner of that company. And when you treat it as such, then that's how you grow your wealth. And I'll also throw out this little caveat. If you think of the richest people in the world today and throughout history, the one common denominator is the vast majority of them owned businesses. Now, granted, it may be one business. John Rockefeller owned Standard Oil, for example. One of the wealthiest men, J.P. Morgan, he owned lots of businesses. So you think of today, Warren Buffett, Bill Gates, Jeff Bezos, all those people owned a business, and that's how they became fabulously wealthy. Now, I'm not guaranteeing that if you start investing in the market, you're going to become fabulously wealthy, but it is a way to grow your wealth. And that's how these men and other people, all people have done it, and you can do it too. So that's how I kind of try to think of it.
Yeah, totally. Well, isn't it risky?
Well, of course, there's always every investment has risk to it. Really, the only thing that's not risky is as low risk as you get is investing in a T-bill for the government or putting the money under your mattress. But that's no benefit either, because if you put your money under your mattress, you're actually losing money because of inflation. So as the dollar you buy today is not the same value as 5 years from now. So if you stuff that dollar under your mattress and wait for 5 years to go spend that dollar, it's not going to buy as much milk as it would today. And so you're actually losing money. So savings accounts are very safe, but they also don't pay anything. You have treasury bills, which are government bonds that you can buy. And right now they're paying 4.5%, 5%, somewhere in that range. And, that's not horrible, but it doesn't match what you can get with the stock market. But there is some risk. But if you hold on, if you buy now and sell it 20 years from now kind of thing, then you have a much, much better chance of getting a better return over a longer period of time. If you're trying to buy in and out, or air quote, time the market, which is nigh impossible, then you will probably lose more than you win if you try to do something like that. But if you buy and just keep buying and keep it in the market and let the money compound, it will do the magic for you.
Yeah. And the reason for that is because when you buy the market is made up of, let's take the S&P 500. That's the most commonly understood market. When people say, I'm buying the market, I'm investing in the market, the S&P 500 is the benchmark for that. So you have 500 companies, some of the biggest, some of the fastest growing companies. Sure, if you're not taking the time to pick the stocks and understand the businesses and figure out who's the strongest, who's the weakest, if you just buy the market, which means you're kind of just buying all the businesses in the economy, then as the economy grows, so does the value of your investments and all the little pieces of the businesses you own. And that's what you do. And that's what's in your 401k. And that's what's in your investment. If you buy, total market index, kind of like Evan likes to talk about, or, just a S&P index, that's what's going on. And so to your point, Dave, about the timing, yes, in the short term, there's a lot of fluctuation in the market. You get times where everybody gets really excited about the stock market. I mean, I remember 2020, 2021, people who never wanted to talk stocks with me ever were all asking me, what's your thoughts on GameStop? Is now the time to buy? And so we get those kind of cycles and those kind of waves, and they just kind of happen every once in a while. The previous kind of parallel to that would have been the dot-com boom and bust when all the internet stocks became crazy expensive. So you have these forces, these cycles where money flows in and out of the market. And there's years where the market does hot, and there's years where the market does poorly, years where people are more fearful, years where people are more greedy. But over the very long term, if we're to zoom out again, you look at over 100 years of data, you look at 5-year, 10-year, 15, 20, the longer you zoom out, like Brian Feraldi says, if you go out to 20 years and you buy a stock, you're almost guaranteed to at least make money on it, or if you were to buy the stock market. So the reason for that is because over time, the economy expands. And it doesn't happen all at once. It doesn't happen in a smooth line. You have bumps in the road. We all know that. We all know how human progress and innovation works. But because of that is the driving force, that is why you get over the long term, as long as you're hanging on, you get that nice 10% a year return. You pay the price for that by having a strong stomach and ignoring the fact that it can be very hard and very scary to hang on, especially if there's always chatter to talk you out of stocks. I think the latest one I've heard now is like, US is not the place to buy stocks, whatever. It's always a new narrative. So if you just decide I'm going to have the resilience to hang on for the next several decades, that's how you get those returns. But unfortunately, it's not something that is as common, even though it's kind of widely known and people kind of understand it. Unfortunately, there's studies that show that average investors don't get that full return because they tend to be emotional. And that's why you have to go back to the basics, because if you can understand the basics, then you remind yourself, put things in perspective. Okay, over the long term, we're going to make a good return here.
Yeah. And to illustrate that idea of money compounding, I want to throw out an example. So Benjamin Franklin bequeathed £1,000 or £1,000 when he died in his will to the city of Philadelphia. And today's money, that's around $4,000, give or take. And by 1990, that was worth over $2 million with no additional investments, no dividends or anything. It just grew that much from, I don't know, 120 years or so. So that's just a small sampling of how powerful investing in the market and staying in the market can be. And Warren Buffett's another great example. He's been investing for 50, 60 years. We don't know if we'll all have that same track record, but the vast majority of his wealth, he accumulated in his later stages of life. He's now 94-ish. And I think around the time he was 70 is when he started to become one of the richest men in the world. And it keeps growing. That pile keeps growing because it just keeps, like Andrew likes to say, it's a snowball. And as it rolls down that hill, it just gets bigger and bigger and bigger and bigger and bigger. And so when you see a chart of Warren Buffett's wealth from the time he started investing to today, it's basically just, a hockey stick. And it's an amazing thing to see. And yes, he's putting money to work, but his main investment, again, is Berkshire Hathaway. And he owns a business, and that's how he's generated his wealth, is ownership of that business. He's not out doing crazy things, trying to take lots of big risks. If there's anybody that's anti-risk, it's probably him. And he's a great example of how you can invest safely for a long period of time and do really, really well. And I'm not saying that we will be Warren Buffett. We won't, but we can emulate what he's doing, and we can have success just trying to follow that business model. And that's how powerful this idea of compounding is. Unfortunately, it's not taught in schools enough. It wasn't taught when I was in school. Of course, I'm ancient now, and so it's hopefully changed. I haven't heard my daughter talk about it yet. I'm hoping it will. I'm trying to teach her about it, but it's Einstein is reputed to have said it's the eighth wonder of the world, and I agree with him. It's a powerful force that doesn't get enough attention.
Yeah, for sure. For sure. 10% of $100 doesn't seem like a lot, but 10% of $1 million, that's a good living right there.
Yeah, right. Yeah, that'll fund your retirement.
There you go.
Yeah, for sure. So it's a powerful thing. And I think the other thing I think that we want to highlight is that we focus mostly on individual stocks. And I think if you're out there and this idea sounds good to you, understand you need to kind of pick a lane. You need to figure out what kind of investor you want to be and then do it. It doesn't have to be sexy, and you don't have to buy all the fancy stuff that you hear all the people talking about around the dinner table. And yeah, that may make for great conversation, but they may not necessarily be the best investments for you. And that's the big thing. Is I think a lot of people get wrapped up in this idea of, I really want to invest, but then you were talking earlier about the stomach, and I think Peter Lynch made this comment, that the stomach is the most important organ in investing, because being able to tolerate ups and downs, and there will be ups and downs, that being able to tolerate that is the most important feature. It's not intellect. And Warren Buffett said the same thing, that you don't have to have a genius IQ to be successful in the stock market. And so let's just kind of dispel that myth right up front. But I think when you think about investing, you need to figure out what works for you, what risk tolerance you can handle, and how much work do you want to put into this. So it's great. But I think when you decide, okay, how do I want to invest? If I know, okay, the market is the place for me to be, I'm going to put all my money in some ETFs, just like you would with your 401k. And that's awesome. and it's money in the market. It's going to get you where you want to go, and you can go live your life. But if you're like us and you love learning about businesses and discovering how these companies do what they do and see how fascinating it all is and endlessly fascinating it all is, then, come along for the journey with us.
Yeah. Are there certain lanes that you feel like people tend to pick, and how can, like, if somebody's listening, they're like, I don't even know what you mean when you say a lane. Like,
Right.
can you give us more specific and help guide people down picking the lane?
Yeah. So I think that's a great question. I think the way that I would kind of bucket them or put people in lanes would be, number one would be, the first question you want to ask is, how much involvement do I want to have? Do I want to do what Andrew and I are doing, or do I want to have things done for me or sort of done for me? So if you're in the camp of sort of done or done for me, you have choices of investing in your 401k. And if you have that option at work and they have a match, start today. Sign up today before you go home. Sign up for it today and start getting that match, because that's free money. We've talked about that before in the past. It's free money. And if you're giving it up, shame on you. Number two is, the 401k is a great place to start. And if that's all you want to do, more power to you. Max it out as much as you can. And that's a great way to build your wealth. The other way you can do it is you can use more air quote passive investing, where you can buy the different funds that Andrew was mentioning earlier. You can use those kinds of ways to invest. And it could be minimal effort on your part, and you can do it once a year. You can just look at your portfolio and adjust accordingly. And you just set up automatic investments. We were talking about that with Evan. He and I were talking about automatically using investment accounts. And so at Any Rate, our other podcast with Evan Rate, he talks about that, and it's very easy. You just set it up automatically. Money comes out of your paycheck, goes into Fidelity, for example. Fidelity, you set up it to buy a particular fund every week, every month, however you want to do it. It's automated. You don't have to think about it. And next thing you know, wow, I got a lot of money here. That's great. So those are kind of two lanes. Another lane is, let's say you have money, you want to work in the market, but you don't want to do all the effort. Then you kind of have two other choices. One is you can use a financial advisor, and they will pay you. You'll have to pay them a fee to manage your money and things. And there's advantages to that, and there's disadvantages to that. And then the other avenue is to work with somebody like Andrew. Follow his stock picks, and he does all the heavy lifting for you, and he can make choices for you and pick individual stocks, and he can help. You can kind of follow along and help with portfolio maintenance and balancing and things of those nature. So there's a lot of stuff you can learn doing it that way. And then the final lane is like, I want to do it myself. I want to learn all this stuff. And then you got to start reading. And that's it. So, I mean, that it's maybe a little longer, but that's kind of how I try to lane or bucket everybody. And I think if you follow those guidelines, then you'll find something that works for you, because what works for me may not necessarily work for you, and there's nothing wrong with that. It's just, you just need to find what works best for your life and what your goals are. And then once you got that, go with it and go.
Yeah. So let's talk to the one who, they have the time, they have the energy, they have the passion.
Mm.
They've decided they want to go down that lane. Is there a next logical step?
Start reading.
Start reading.
Start reading. I think the first thing you need to do is you're going to have to read. There's no shortcut. There's no easy way. There's no hack. There's no easy button. You have to read. And I would recommend starting with some easy books on money, things like Psychology of Money, Richer, Wiser, Happier by William Green, who we've had on the show a couple times. Great book. Those are fantastic books for starting. Peter Lynch, One Up on Wall Street. I think that's one of the ones you've always recommended. I found it super, super easy to read, and does a great job of explaining air quote complicated topics. And that's where I would start. And then pick a company and start reading its 10K. You're not going to understand a lot of it, and that's okay. Start making notes. Pull up Wikipedia, or pull up our website, einvestingforbeginners.com, and start learning what is a gross margin, what is revenues, What is this whole 10K thing? What is changes in working capital? ROIC, all these things you're just not really going to understand, but you're going to have to start learning them. And that's reading is the easiest way to start. I liken it to learning a new language. When you learn a new language, you have to kind of immerse yourself in it to figure out the basics of what's going on, as well as learn the terminology, the lingo, and then start understanding it. And that's kind of where I would start. I'm curious where you would start.
I like what you're saying, like the whole language idea, immersing yourself. I mentioned this when I was with Evan, one of the recordings we did recently. There's no shortcut. There's no substitute for immersing yourself. And even if you don't understand all of it, just letting the words and the jargon and the ways of thinking, letting that just permeate. And I love blogs and books for that.
Mm-hmm.
I've said this before, I'll say it again. One of the best investments I ever made was a Audible account, Audible membership. And I did that very, very early on. And it was just a constant, like, I have a credit, I better use it. I have to read another book. And it was just month after month after month. And then that really starts to compound. The knowledge compounds just like the money compounds. And so before you know it, and then you start putting money into the market. And then as you start to collect better and better businesses, before you know it, you start to really increase your chances of really getting that wealth snowball. And doing it, if you're really good at this game, you can do it at a faster rate than most everybody else. That's for the select few, though, so don't get your hopes up. But we're all chasing that dream, right? So that's kind of the end goal. But to take those steps intermediate wise, I think approaching it like you're learning a language, I think is so beautiful, because nobody expects to learn a language overnight. But you get people who think, oh, I'm going to dive into this for a week and I'm going to become Warren Buffett next weekend. Like, come on, right? So I love that. I think it's really a perfect example. Treat it like a language, immerse yourself. You will be fluent one day, but it's going to take work and it's going to take time, but it's also going to be worth it.
Yeah, for sure. And I love that idea of the Audible subscription. A lot of people, I don't have time to read, or I don't have time for this. The vast majority of us commute to work. And if you have a half an hour commute both ways, that's an hour you could listen to a book. And I think it's a small price to pay for turning off sports radio or the latest Taylor Swift album or whatever it is that you listen to.
Or our podcast, I guess.
Or well, maybe not the podcast. No, not the podcast. No. But listen to a book when you go for a walk. Yeah. When you take, if you have dogs and you have to take your dog for a walk, put the AirPods in and listen to a podcast or listen to a book or anything along those lines to, as Andrew said, to help keep immersing yourself in it. And knowledge will compound just like money will. And the more that you learn, the more you'll understand it. I'll give you an example. When I first really started to get into this, I came across Michael Mauboussin, who's probably arguably one of the better finance teachers out there. Very clear, concise writing, really good at breaking down complicated topics. I remember reading a paper that he wrote about a metric called return on invested capital. And I had been maybe a year, maybe 6 months into this. I did not understand a stinking thing. I was like, just zoomed right over my head. And so I put it aside. Like Andrew said, I let my eyes wash over the words, but it didn't really sink in. Put it aside. A couple years later, after more research, more reading, more learning about this, starting to write about all this, then I came back to it and all of a sudden, voila, it made sense. And it's only because it wasn't because I got smarter in those couple years. It was because I spent the time working on the skill to get to the point where I could understand this. Now, like Andrew said, there's plenty of smarter people out there than me and can figure that out faster and awesome. But yeah, set expectations. You're not going to be Warren Buffett in a week and a half. So yeah, that's all I got to say about that.
Thanks, Forrest. Just be like Forrest. Buy shares of Apple,
right?
Like 15,
there you
20
go.
Years ago, and you're set.
Yeah, there you go.
Are there certain types of stocks that you think are better for learning these skills you need to be a good stock picker?
Oh, that's a really good question. I think I think a couple things probably come to mind. Number one would be, it's kind of an old adage. I think Peter Lynch is the one who threw it out there first. Buy what you know, and that can make it a little more closer to home, and it can also make it a little more interesting for you. I try to follow my curiosity with most things, and I would probably encourage people to do that with stocks as well. Understanding that you won't understand everything, and there are going to be certain things that you're going to come across that definitely need to go in the too hard pile. But I would start. I would probably start with things that you're familiar with or use, and or the company you work at. So, for example, I used to work for Wells Fargo. Banks seemed to be the thing I landed on to start trying to learn first. Big mistake. Don't do that. That's probably one of the harder places to start. But because I worked there, it just made sense because I had people I could ask questions about things I didn't understand and whatnot. But think about where you work. That could be a great way. Or think about companies that you're interested in. Maybe it's products that you really like and use, and you could start there. That's, I guess, how I would maybe consider it. What are your thoughts on that?
I like the way I did it, obviously. Who doesn't? I cut my teeth in the value investing space, and I think that was very good for two reasons. The first reason, making a mistake in the value stock world versus making a mistake in the growthy graveyard is like way different experience. You're talking about you're talking about the difference between like losing 80, 95% versus losing like 25, 30. Obviously, I mean, I think I did lose like 60% on Carnival cruise ships during the pandemic when they couldn't take
Sale
cruise ships out.
at all?
Yeah. Like they're literally all their revenue. But other than that, like I do pride myself in like minimizing losses. And so I think that's a great place to learn. And then secondly, those type of businesses work really well for mathematical analysis. And I think it's really hard. It's really, really hard. And we try, and we're going to keep trying. We're going to keep fighting for you.
Mm.
We're going to keep talking about gross margin. We're going to keep talking about operating margin. We're going to keep talking about DCFs. But it's really hard to learn until you actually get your hands dirty and start doing the calculations. And you can't really do that on the companies that have just IPO'd.
Right.
So those are my two reasons why I would say start in the growth stock space. And then if you branch out from there, a lot of people have done that too.
Yeah, that's great advice. I would strongly agree with that. I think staying in the safer side of the market would be a better place to start because it's an easier, more forgiving place to learn the skills because we aren't all gonna. I guess that's another expectation that people have is that stock pickers are 100% accurate on every single pick they get, and that is 100% wrong. I think Peter Lynch said if you get 4 or 5 right out of 10, you're doing pretty good. And he picked hundreds of stocks, and so I think the GOAT, Warren Buffett, made plenty of mistakes, and he'll freely admit it. And so I think dialing down the expectations that you have to be perfect, and if you're making mistakes along the way, that you're a failure, and that is not the case at all. The bigger trick is to learn from the mistakes and why did I make that mistake? Was it something on my part? Was it something on the company's part? Did I miss something in the analysis? Is it just an unforeseen COVID happens and Carnival ships can't sail anymore? I mean, who has that on their bingo card? So those things are going to happen, and you have to understand that, but it's also part of the process is trying to learn from the mistakes as well as the successes. Did I invest in Visa because, and it did well because I was right, or just because I got lucky? I mean, those are important questions to ask yourself when you're doing this. But I would definitely encourage, if you're like, oh, this sounds great, find one thing and go out and put $50 on it and just start. It doesn't have to be a winner. It's not going to set you up for retirement. That's not the goal. The goal is to get skin in the game. And because once you have actual money in the market, it's going to be a lot more real to you. Like I worked really hard. It took me an hour and a half, 2 hours to make that $50. and now I'm going to put that on company X, and you're going to watch it and you're going to be very interested in how it does. And that can be the first great learning tool as you start to go into this process, because like Andrew said, you're going to have to do the math to figure out all these different things that are important to why the company is doing well and maybe why it's not doing well. And you'll learn more by having skin in the game quicker than you will just waiting for the perfect time to start investing. And then once you kind of get your feet wet, then it's a lot easier to keep moving forward and keep making progress and keep putting money into the market as you find things that you want to invest in.
Yeah, I love that advice. So I'm going to ask you to go into the time machine a little bit,
Okay.
because one of the things that I've enjoyed hearing from members of Value Spotlight is, even though they've been doing this a while, they still find Back to the Basics episodes helpful and refreshing, right? So we have people of all levels who listen to these. Can you take us back to like a time where you were most disappointed or discouraged in your stock picking journey? And if somebody's at that place right now, what would be the word, 2 words, 1,000 words you would say to them to help push them along?
Okay. Yeah, I can think of a time. So when I first started investing, the first investment I chose was Microsoft, and that one did really well kind of right out of the gate. So I got lucky. I truthfully knew nothing about it other than the fact that I used it at work every day and I knew the name. I knew nothing about the business, nothing about the financials. I just got lucky. I started following some investment advice from an online service, and they suggested 3 different companies. One of them, which was, oh gosh, Microsoft actually just bought them. The gaming,
Activision.
yeah, Activision, and that went up and to the right, like immediately. It went from like $25 to like $90 in like a month. I was like, wow, this is easy. The next 2 picks, not so much. I put more money into those because I was like, oh, this stock market thing is easy. And one was Sierra Wireless, and the other one was Westport something or other. It's like they made hydrogen gas, I think it was, for diesel trucks or trying to convert. Anyway, both complete dumpster fires, and both lost 90 some percent. And I started thinking, okay, what am I doing wrong? The market is, a casino. This is really, really hard. And what do I need to do to get better? And so I remember thinking that maybe this isn't something I want to do. Maybe I need to, what do I need to do to get better? And I actually happened across Andrew's blog and at the same time, and I started reading Andrew's blog every Wednesday when it would come out in my lunchroom, and I would go and read it, and it just inspired me to learn and to dig deeper and start really learning about the market and learning about the companies and how to analyze businesses, and kind of the whole value investing thing I got from Andrew's blog. And that's really what kind of inspired me to keep going. Was I found a mentor, I guess is the best way of putting it. And I found a mentor that could help me kind of keep going and realize what I was doing wrong and how I could fix it. And that's why I'm here today.
That's awesome. I wasn't expecting that.
Yeah.
We did go in the time machine. Whew. We're gonna run out of oil in this thing at this point. we go back any further, we're gonna be prehistoric. Oh man.
You got? Do you have a story? Do you have a story?
Yeah, I mean, there's probably, I can think of 2 of them. One of them is during the 2020 bear market, and I've written about this, and I turned it into like a journal on the blog, basically like letter to my future self, because I remember going through it and looking, and my portfolio was just decimated, but I held on, and so many of those rebounded, except for Carnival. Oh, that's okay. And Disney. We won't talk about those. And then something more recently with one of my biggest positions, and it just hasn't panned out. And yeah, you just question like you're going in the right direction, but you get stocks that don't necessarily cooperate. And you wonder how much longer is that going to happen? And I think that's a pretty common thing. Like, I'm not saying this crazy controversial thing these days. Like, value investing has been a very hard thing to do because it has trailed the market for so long. So you do wonder, and I don't have like a good hero story for you, like to come out of the other side, but I will say that I think knowing the businesses deeply helps a lot. And if I contrast going through 2020 versus going through underperformance more recently, in 2020, I didn't really have businesses I felt strong about. They were a lot more like tickers. They were a lot more like, okay, once this thing makes me money, I'm out. I still have a few of those in my portfolio, which is probably a few too many. But, I also look and it's like, you got Starbucks, Apple, Google, Microsoft, these great businesses that I'm happy to be a part business owner in. Like, straight up, there is pride there. And obviously you buy them hoping that you're going to outperform the market. But there are times, at least I've had times that I've had to deal with where it's like some of these positions are not outperforming. And so you question, were they the right decisions? Am I doing the right thing? And having that pride in those businesses has helped a lot for me personally.
Mm-hmm. Yeah, that's awesome. That's awesome. I think the bottom line is that you're gonna go through seasons or periods where your portfolio won't do as well as you hope, and it's always good to take stock of why that is and look inside and see if it is something behavioral on your part that's maybe causing you to maybe choose things that aren't the best performers, or if it's just part of the being in the market. Charlie Munger said once, if you can't handle 50% drawdowns, you don't deserve to be in the market. I don't know if I want to be quite that blunt, but I think you have to understand that it will go, not everything goes up and to the right forever. You may have periods where it will, and you think, wow, I'm the greatest stock picker ever. And then it has periods where it won't go up and to the right. And then you think, oh, what am I doing? It's part of the game. And if you just stick with it, if you have faith, like Andrew said, if you have faith in what you know, then I think over time that will tell out for you.
Yeah, it's a long game, right?
It is the long game, yes, for sure. All right. Well, with that, we'll go ahead and wrap up our show for today. I hope you enjoyed our little back to the basics episode, and we will revisit these ideas from time to time. So if you have any questions, or if there's something you'd like us to talk about, back to the basics or otherwise, reach out to us at newsletter@einvestingforbeginners.com, or send us some questions on the Spotify app. That's another great way to get in touch with us. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on safety. Have a great week, and we'll talk to you all next week.